Here's what's likely been on many of your minds over the last few weeks of market volatility. Jordan, should I pull my money out now before it gets worse? And you're saying that because from February 19th to March 13th of 2025, the S&P 500 had dropped over 10%. Guys, that's less than a month. And you may be feeling like you're watching years of savings slip away. Hi, I'm Jordan Lehman, founder of True Wealth Retirement Partners. And every day I help my clients create steady retirement income, invest smarter, and save money on taxes. And I want to share what's working for my clients so that you can apply those principles yourself. And by the end of this video, you'll know exactly what a market correction really means for your retirement and how to navigate it without making potentially costly mistakes. So let's get into it. Listen, market corrections can feel scary, especially when you're relying on your investments for your retirement income. But here's the thing, history tells a very different story than what our emotions might lead us to believe. And that's exactly what we're diving into today. So, first, let's define what is a market correction. A correction is typically defined as a market drop of 10% or more from a recent high. Now, while a 10% drop might sound like a lot, history tells us that these corrections are normal. And by the way, if you've not watched my previous video on Trump, tariffs, and your retirement, I'd recommend you do so, as that video outlines how often these corrections actually have happened. But when you're in the middle of it, it doesn't feel normal, does it? It feels like uncertainty, panic, and the urge to make sudden changes. Maybe you've even considered pulling out of the market altogether, and that reaction is completely understandable. But let me show you something that might help ease that anxiety, and I want to pull up some real data that shows us what has happened after big market declines. So this is a helpful resource put together by my friends over at Dimensional Fund Advisors, looking at the average stock gains after big declines. And this is looking at an index of the overall US stock market going all the way back to July 1926. And this is through the end of December 2023. So correction, it's in the news. S&P fighting a correction. That's a 10% market decline. Well, what has tended to happen, or what's happened on average after a correction? The gray bar is average 1 year cumulative return. The green bar here is the average 3-year cumulative return, and the blue bar here is the average 5-year cumulative return. So on average, after a correction, 1 year later, stocks are up 11.8%. 3 years later, stocks are up 34.6%. And 5 year later, on average, stocks are up 68.7%. Now, the temptation in a correction, or even steeper downturns, we see the same trends happen there as well. The temptation is to sell after you've lost a bunch of money, locking in the loss, and then you have to know when to get back in. Easier said than done. So what often happens in corrections is people get out, they miss the subsequent recovery, but lock in the loss. It's exactly what you don't want to do. So the idea here, guys, is that these declines are normal. And we know that historically stocks have recovered. The issue isn't that they go up and down, it's that you make a poor decision along the way. So what does this all mean for you? Well, here's the key takeaway. Corrections are temporary. And if history is any indication, markets tend to rebound over time. That's why making rash decisions like selling off investments in a panic can actually lock in losses instead of giving your portfolio the time it needs to recover. Here's the truth. Investing is not about timing the market, although that seems exciting. It's about time in the market. And the longer you stay invested, the more that you're going to benefit from market recoveries and long-term growth. That's why it's crucial to have a long-term plan, one that accounts for these inevitable ups and downs. And instead of reacting emotionally, you want to make sure your portfolio is built to withstand volatility and keep you on track for your retirement goals. Now, if you want my help to stress test your portfolio and make sure you're positioned for long term success, feel free. Check out the link in the description to learn more about our free tax smart retirement assessment. And if you found this helpful, make sure to hit that like button and subscribe for more insights on smart investing. So, thanks for watching, and we'll see you in the next one.